हाय गाइस, गुड मॉर्निंग। कैसे हैं आप लोग?
गुड मॉर्निंग सर।
यार, आई एम रियली सॉरी फॉर द डिले. आई एम not totally well today, so could not start on time. uh, Anyways, we'll possibly have a short session. Just don't want to cancel the class at the last minute. But whatever best we can do, we can. uh, can we quickly have the video cameras on for everyone? Quickly, everyone. Okay, जी. हाँ जी. Any questions, doubts that we have from the previous session? Nan, were you able to go through the technical articles as well for governance?
Uh,
Yeah.
hi. So yeah, what I did is I just went through the revision of whatever given in the study text. Entirely, I went through that. Uh, and you also told no, look into the corporate governance of from the annual report of a particular company. I've done that part also. But with respect to questions, no, I did not have sufficient time to look into that questions. With respect to technical articles, I went to one or two from ACC website. With respect to different stakeholders, like high power, high interest, high power, low interest, low power, low interest.
That is something that we still have to do.
That's what I heard. That was in the technical article, the governance stakeholder.
Yeah.
Different varieties of stakeholders like internal and external. All those things I have gone through, but revision kit questions I have not gone through.
Okay.
And I also found one important. Like I went through that ITC's board corporate governance. There I found out that chairman and MD is same in the ITC. But as per the UK Corporate Governance Code, chairman should be different, executive director must be different. But here, chairman and MD is same. So I have a doubt that whether MD is a part of executive committee or not.
So technically, if you think from a definition perspective, definitely MD is more about managing day-to-day operations. So he is a part of the executive board. What is happening is that we are studying the UK Corporate Governance Code. Initially, even the SEBI, the Stock Exchange Board at India, they also want to apply similar guidelines, and very slowly, they are making these things applicable. Okay, slowly and steadily, you'll see similar set of guidelines becoming mandatory or possibly applicable on the Indian companies as well. If you recently, not possibly recently, a year or something back, just quickly, search out a study wherein Mukesh Ambani resigns as the CEO and continues as the chairman of Reliance. Just, quickly search this on Google.
Sir, I have a question.
Yeah.
Can NED be related parties? Like if someone's part of my family, can he also be non-executive director?
He will not be an independent non-executive director.
Okay, but when I searched, when I looked it up, it says that Akash Ambani was made NED. How is that possible?
Yeah. So then again, those are the Indian companies, and slowly and steadily, similar set of guidelines will become applicable over here as well. Right now in India, if you talk about, it's more about, who is managing the operations and who is just, attending the board meetings. That ways they have bifurcated the power. But, slowly what will happen is all these principles of corporate governance will as is become part of or become applicable to the Indian companies as well. And when they do, that's when these companies will have to kind of comply and ensure none of the family members stay a part of non-executive director part.
So there's this HUF that runs in Hindu Undivided Family, right? The family businesses in India, do they run according to that rules as well, or just about the corporate guidelines they run about?
So HUF is more about kind of an entity, right? So either I want to set up my business or possibly I have some income. Either I can do it at my own self as an individual, or possibly I can form a HUF, Hindu Undivided Family. What is that? So possibly me, my wife, my son, okay, my lineage will be the part of HUF. If this HUF is maybe my father has created it, so then he will be the Karta, the head of the family
Yeah.
is the Karta, he is the one who drives the HUF. Fair. Now, again, I have to register that HUF somewhere. That's when I will get a separate PAN card of a Hindu Undivided Family. Okay. So the idea is the entity that I have formed, whether I register it as an HUF or a corporate or a proprietorship or whatever. It's more about how you register the entity, and basis that the rules become applicable.
So if I register it as an HUF, I don't have to follow that. I need a certain amount of NEDs and EDs.
HUF में तो फिर डायरेक्टर्स की बात ही नहीं हुई ना, because HUF, I am the Karta, okay, the eldest male member will be the Karta, he is the one who basically heads that particular HUF,
So,
okay.
if we talk about business, what capital or what net income a business can have if he wants to run as an HUF? Like, is there a limit or anything could work?
Anything can work, even possibly, I'm not running a business, I just have a rental income. So for example, I earn a salary plus I have a rental income. Now I want to get some kind of a tax exemption. So what I do is I form, ek to mera, I have a singular PAN card of my individual. Okay. I can form another Hindu Undivided Family. So what will happen is that tax exemption, the slab limit ka benefit, I will get at two places. One, at a personal level, second at a HUF level.
So when HUFs pay taxes, do they pay as an individuals or as companies?
Individuals.
Individuals. Okay.
Uh, and I also found that, see, with respect to, so you mean to say that um, as per Indian Act, Indian SEBI Act, a family member can be a non-executive director, but as per UK, there is no such a family member cannot be a non-executive director, is it?
And the reason is that he will not be independent, and we need independent nets.
Correct. What I saw here, as per that, in ITC, other than that MD, they have three executive directors, including CFO, nine non-executive directors, and there is something called other non-executive directors. Okay, here they have within non-executive directors, they have been classified into independent and non-independent. That
Correct.
is
So the ones that we kind of hold true, or we, when we as a part of ACCA or the UK corporate governance, we say that we need non-executive directors, we're talking about the independent non-executive
okay.
director. That limit only we will consider.
But even in our statistics also, it doesn't state that non-executive directors must can be independent or non-independent, because it is also mentioned that uh, they might also be not independent because they might have a financial interest or another interest in the company.
See, practically what happens is, now the question is, if I am an independent non-executive director, can I hold certain shares in the company or not? Okay. And the answer is there's no defined limit. Okay, that's to how many shares can an independent non-executive director hold. He can hold some shares, okay, provided there is no substantial interest. Okay.
Okay.
For example, I want to become an independent non-executive director and I hold 100 shares in Reliance. Do you think I'm too much dependent on the share prices?
No, no.
I can still provide my independent, unbiased opinion.
Correct. Correct. And one more thing, what I found it is like with respect to board committees, we have risk nomination, remuneration, and audit here. But here you have audit committee, CSR and sustainability committee, nomination and compensation, security holders remuneration relationship committee, corporate management committee, independent directors committee, then risk management committee.
Yeah.
So
So to have a better governance procedure, the ones that we studied, those are the bare minimum that companies should have. Okay. But to have a better, governance mechanism in place, what the companies do is they have dedicated subcommittees in place. Okay. So one is specific. So if, for example, my company is too much invested into environmental laws. So I will have a dedicated environmental committee whose only job will to oversee whether I am taking care of all the actions or the compliances required with respect to the environmental laws.
okay. Okay. So I think with respect to this, we need to refer UK companies rather than Indian companies, right?
Yeah.
Okay.
Yeah. Chalo ji. Perfect. I am sharing the screen. Pick up a small section today. I don't think I'll be able to kind of cover much of the questions today, but still, I would want to kind of give out my best. Let us do risk as a section. Okay, ji. What do we understand by the term risk?
When the actual result differ from, I mean, when the actual result is different from the expected result, then you can call it as a risk.
Okay. Anyone else who wants to add on to this?
Uncertainty of the result.
Uncertainty. Okay.
The
There.
probability, like how much of a risk it is.
Okay. How much of a risk it is? Okay. So I'm asking what the risk is, and you're saying how much of a risk it is. So that's a fair answer.
No, I'm saying like the probability matters in like if a task can be done like 40 times, there's a risk that it cannot be done like in that way.
Okay. Okay, ji. So generally, whenever we talk about the risk, a negative thought comes into our mind. Okay. We say something bad is going on over here. If I say don't do that, this is too risky, that means that there is a chance of loss, maybe financially, maybe non-financially. There is a chance that something might go wrong if you do this particular thing. Correct. That's a general thought that we have. So what we can possibly do is to mitigate the risk. Can we eliminate the risk in our lives?
No, we cannot.
Okay. If you want to eliminate the risk, then you'll possibly have to stay in a bunker, isolated from everyone, no human touch so that you do not get contaminated. You do not talk to anyone. You have proper pure water, food so that you don't fall sick. You basically stay away from all the flies and humans and what do you say, earthquakes, etc. But that's not practical. That's not the way to live. Correct. And same goes for the corporates. The corporates as well, they cannot eliminate the risk. They will have to do business. They will have to sell goods on credit. So selling goods on credit is a risk. Why? Because I might not be able to recover 100% of the money. Fair. So you cannot eliminate the risk, but at the same time, I would want to do a risk assessment. I would want to know what is the level of risk that my entity faces. Why? Because even the shareholders, considering their money is invested, they would want to feel safe. Ki, okay, boss, I know it's an equity investment, it might go to nil, but I don't want it to be just invested into very risky decisions. Fair. So the companies, they are required to perform a risk assessment to understand the risk exposure. How much risk does the company face? Okay. And basis the assessment, basis, understanding whether it's a high risk area, medium risk area, or a low risk area, I will take the decisions. Okay. I can possibly go in for insurance to cover the financial risk. I can possibly, wear safety gears wherever required. So, for example, my company is a mining organization, and we value safety as an utmost priority. Be it the mines, be it the offices, safety protocols are always mandatory. Okay, so having the proper safety gear in place, having proper procedures in place. Okay, these are the ways in which I can reduce the risk. Fair. Then I can also, possibly outsource the operations. Okay. Let us say manufacturing involves a lot of risk. Let me outsource that to an expert third party so that by chance there's something wrong with the machinery, there's something wrong with the people involved, the ownership as well as the risk is with the third party. Okay. Now, my question to you guys is risk assessment one-time exercise?
No.
Okay. Because it is a constant thing that you have to do. Okay. Uh, it might be possible that every day a new risk comes in. For example, if I talk about, the COVID pandemic, okay, no one knew such kind of a thing could come in wherein people will have to work from home. And working from home, it has its own set of challenges because you have to see in an office setup, it is okay to provide access to the confidential data. Why? Because we restrict laptops, we restrict data being shared outside the portals. But in a work from home setup, you get connected to the third party internet applications, and of course it becomes more risky. Okay, there's also a risk whether the employee will work or not. There's also a risk whether his equipment will work properly or not. There's also a risk if the data might get, sorry, the data might get stolen. Okay, or be prone to cyber attacks because of the internet connection issues. Okay, so these are all the risks that the company faces, and every day, you might come up with a new risk. Okay, if a new competition is entering into the market, that's a new risk. If you launch a new product, that itself comes with a new risk. Okay, so it is basically a uncertainty of something going wrong. We always say higher the risk, higher the reward. What does it mean? Hanji, what do we mean by the term higher the risk, higher the reward?
So if we take high risk, for example, if any project wherein the chances of success might be minimal, but if they succeed, it will be a huge one. So for that, they say higher the risk, higher the return. This term is usually used in this kind of options trading, where they used to say if the market goes according to their prediction,
Hmm?
their investment will be less, but the returns will be more than what a normal investment return should get. Suppose if it goes against it, then they lose the entire capital. So for that, they say higher the risk, higher the capital.
Okay, absolutely. This statement does not hold true in all the scenarios. So For example, a risk of fire, if your area is prone to a lot of fire accidents, there's a higher the risk. But what is the reward in that case? Because insurance will just compensate you. Okay, it's not a reward that you guys are earning for the fire. So the idea is, it's not, the statement does not always hold true. It is more about the fact, I would want to cover those operations. I would want to kind of venture out into high risk operations only if I expect certain higher returns. Okay. Uh, for example, if I want to invest in stock market, fair. And if I invest in Reliance, I will be okay with a normal reward. Why? Because it's an established company. I know my investment is safe and the money will not go into drain. At the same time, if you ask me for to invest in a new venture or a startup or a small cap company, I would expect a higher return. Then only I would want to invest in that particular company. There's a concept of conformance and performance. Conformance and performance basically means, conformance is controlling the downside of risk, controlling that you do not go out into very big losses. At the same time, if you want to kind of grab opportunities, you will have to undertake the risks. So performance basically means taking advantage of the opportunities to increase the returns. So for example, opening your business into a new market. Currently you were selling goods in Delhi, but you start selling goods in Mumbai as well, or possibly you start selling goods in international market as well. The idea is that the companies need to maintain a balance. Okay, they need to ensure that yes, they are taking advantage of all the opportunities available. At the same time, they are putting in certain controls to ensure that the risk remains as low as possible. Any questions, doubts?
So conformance would be like your stop loss that you put, for instance, on stocks and things like that.
Absolutely, yes. Okay. Maybe, hiring expert people in your organization, maybe, ensuring that everyone wears a safety gear before they enter the production area. Um, Maybe, if you want to enter into a new market, hiring someone locally who is aware about what things work over there, or possibly who is aware about what are the local laws and regulations that need to be complied with. So those are the conformance or the control procedures that the businesses have set up. At the same time, they are taking advantage of the new opportunity that is available in the market. Okay. So it is always recommended that you maintain a balance between conformance and performance. This is an important question. Generally, whenever risk is getting tested in the examination, it asks you to classify the risks. Okay. And whenever it asks you to classify the risks, the idea is not just, reading through the text and, saying, okay, boss, a new competitor has come in, so that's a risk. You have to kind of classify it, whether it is a strategic one, operational one, tactical one, etc. Okay. Yeah. Example of conformance and performance option. I did not get the question, Gargi. You want to unmute and ask?
Sir, is that mean example means I'm saying ki example of conformance and performance would be option like derivatives one?
Okay. So option again, if you want to kind of go in for an option trading, to requisite possibly buy, call and put together. Okay. So having those balances in place, checks and balances in place to ensure that yes, you are getting returns. At the same time, you're kind of stopping your loss. Okay. You are ensuring that you do not kind of lose out a lot of money. That is an example of your conformance.
Okay.
Okay. Anji, coming back to the kind of risks, uh, anything that basically affects your existence or it impacts you at a strategic level, at the top management level. That is known as a strategic risk. Okay. Uh, for example, for Nokia, possibly the Android and the iOS entering the market because they were still running on the old Symbian software. They did not adapt to the new technology. So that's a strategic risk. For possibly movie halls having OTT apps in place, because what is happening is a lot of movies kind of straight away get released to the uh, OTTs, and hence people are not very keen on going to the cinema halls. So that's a risk. Okay. Online shopping, that's a strategic level risk with respect to the physical stores that are there. Okay. The idea is anything that impacts the overall mission, the overall existence of the organization will be classified into strategic.
Sir, I had another doubt. The VI has been facing some, it had some amounts that was due to government and some settlement didn't happen. So was that a strategic risk or operational risk?
Okay. So in your exam, as well as in the example that you've given up, or possibly in your exam, it is up to you how you want to justify. Because again, there's a very thin line in terms of what you classify as a strategic one, what you classify as an operational one. Maybe depending upon the amount, or maybe depending upon the impact, it might less start classified into strategic and operational. But in both the scenarios, the way you justify, that will fetch you the marks. It's not 100% mandate there. Okay, boss, this is a strategic one, this is an operational one. There's no clear cut listing available, but it is all about how do you want to justify. Okay, so possibly if I want to kind of justify it as a strategic one, I can say, ki boss, these tussles with the government might lead to going concern issues at the company, and hence are to be classified at a strategic level. Okay. Or possibly in contrast, if I want to kind of classify it as an operational risk, I could say, okay, boss, this is an ongoing, tussle with the government, but the company has sufficient balances in place to pay out any fines, penalties, and hence it is not a threat to the existence or a strategic level risk.
Okay, thank you.
Most welcome. Operational risks are basically those which are basically the day-to-day functioning. For example, your vendors, your raw materials not getting received, there are operational issues with respect to the machinery. There is some logistic issues. Okay. There are minor non-compliances. Okay. A lot of key people are leaving your organization. These are all examples of operational risk. Okay. Some other kinds of risks that the company faces, compliances. Now, you can classify this as a strategic one. You can classify this as a operational one. You can also give out a separate heading with respect to non-compliances of laws and regulations. There can also be environmental damage risk. Okay. Economic risks such as interest rates, inflation rates in the economy, a new competitor coming into the market, a new product coming into the market, or possibly your product not working out too well, the raw material becoming expensive, change in government policies, procedures, culture. Okay. So if we talk about Bangladesh right now, it's not fairly a stable country to operate in. It's facing a lot of political and legal challenges to operate business. Then financial risk, for example, your currency. So rupee again is depreciating against dollar. So if we talk about exporting companies, it's kind of still okay for them. It's favorable for them. Why? Because if rupee will weaken, their products will become reasonable outside and more people would want to buy their products. But if you talk about importers, anything that they are importing, it becomes unfavorable for them. So these are again the different kind of risks that the companies face.
I have a small question.
Yeah.
So this type of risk, whether it is a strategic or operational risk, it also depends on the type of industry in which they operate also, right?
Type of
For example,
industry, the situation that you are
yeah,
in, the impact that it will have. Again, basis all of this, you can identify or possibly classify these risks.
that's what. Suppose imagine the company is in a manufacturing sector, and if there is unavailability of raw materials, okay, that raw material is very important for the production. So the unavailability of raw material, will it fall under operation or strategic with respect to this case?
See, let us say the unavailability is to such an extent that you are not able to fulfill your orders, and it impacts your existence because the customers are now not willing to work with you. Then it gets classified as a strategic one. But that's a remote possibility because more or less, a small hiccup here and there is more so classified into an operational risk. Okay. There is a chance that right now the raw material is not available. You might source it from another vendor, or possibly you're in search for another vendor, and that risk gets mitigated.
Yeah, so it depends on the impact, how it impacts the organization also.
Yeah.
Okay. Yeah, thank you.
Most welcome. Again, once you kind of classify the risk, okay, once you kind of identify the risk, you will have to set out a risk strategy. Okay, so one very important question from this chapter is your classification of risk. The second very important question that comes in over here is the how exactly are you dealing with the risk. Okay, so that's where we have the Tara model. And where exactly is it? Hanji. How do you plan? Okay, it mentions as well highly examinable. And how do you kind of associate, or possibly how do you manage the risk? So whenever the question is talking about risk management, the Tara framework comes into the picture. Okay, what you will do is basically you will consider two things. One is the impact and the consequence. The second is the probability or the likelihood that that particular risk will materialize. Okay, so for example, there is a risk that while walking in the market, your mobile will get stolen. That's a risk that every one of us faces. Okay, it's kind of materialized with me once, but that's kind of a different story altogether. But what does that mean? Is it like too high? Is it low? Or what if someone steals my mobile? What will happen? What will be the impact? How much financial damage will I face? Is it a threat to my existence? The answer is no. So as such, I basically just accept this risk. I don't do much about it. I am okay that yes, boss, these things might happen if I face such theft issue with me. It will, it's a low probability. It's not that every day my mobile gets stolen. And as well as if it gets stolen, that's okay. I'll possibly go out, I'll be sad for a while, and then I'll go out and buy a new mobile. Okay. But if I kind of stay in an area wherein such thefts are very, very, very much probable. Okay, there are a lot of thieves in the particular area. A lot of cases are increasing. So that means what is happening is the probability is high, but the impact is still low. So what I will do is I will try to reduce that particular risk. How can I do that? Is possibly carrying a, keeping my mobile in my pocket, not using it while I'm outside. Okay, so implementing controls to reduce that risk. Okay. At the same time, if possibly I have a very expensive mobile, something like a Pro Max or a Fold or anything, I would want to kind of avoid that particular stances. How can I do that? Is possibly not buying a very expensive mobile. You know, if for initially when my mobile got lost, I thought, okay, it's not a very good idea to buy expensive mobiles anywhere. So I avoided that decision altogether. I said, okay, boss, I don't need an expensive one. I'll buy a small mid-range mobile. So I avoid venturing into those areas. Okay. And lastly, if possible, I can also transfer the risk. So one example is if I can possibly take out an insurance. Okay, so along with the mobile, I purchase an insurance as well. What will happen is essentially as soon as if my mobile gets lost or stolen, I will register an FIR and the insurance company will compensate me. So based upon the impact, based upon the probability, I will take the decisions. So that's TARA, the TARA framework: transfer, accept, avoid, reduce. From a business point of view, let us say you are working, your area in which the warehouse is there, it is not very much prone to flooding or earthquakes. It might happen as a one-off case, but it's not a regular occurrence. Okay, even if it happens, there will be less impact considering the structure that you have. So what will you put in a lot of controls, or will you accept that risk? It's a low impact,
Accept.
low probability. Obviously you would want to accept it. On the other hand, your warehouse is in an area wherein there is a very high chance of flooding, and if it happens, you would your entire inventory will get damaged. So would you want to kind of place your warehouse over there?
No.
No.
Absolutely not. You will avoid those scenarios wherein the impact is also high and the probability is also high.
So one more question. Like you said that if you buy an insurance of something, you're basically transferring your risk, but it can also reduce your risk, because I don't think so. Insurance covers each of the loss. Like every loss is not covered under insurance. They give you certain amount only, right?
Absolutely, absolutely. So depending upon the coverage and all, it might be reducing or possibly transferring the risk. Either ways. Transfer also, you'll have to kind of see if it is possible or not. So for example, if I talk about Apple as a company, it does not have any risk with respect to manufacturing. Entire set of manufacturing is outsourced. Okay. So possibly ensuring that the raw materials are there, ensuring they are stacked properly, ensuring that the products are getting manufactured properly. It's all with a third party. Okay. So that is also an example of transferring the risk. Again, if I'm covering any activity wherein the probability or likelihood of risk materializing is high, but the impact will be low, I would want to reduce that particular risk. Okay. So for example, if I'm selling goods on credit, having credit limits in place. Okay. Having credit limits in place is an example of reducing the risk. Okay. Because if, for example, I'm selling goods to Niklesh, uh, I would not want to sell him goods worth more than 50,000. Once he kind of gives me the money, that's when I will sell him another set of goods. So I've reduced my risk to a particular threshold that I can possibly, what do you say, handle. Okay, so very quickly, you can just read through the text below.
So we would buy an insurance when the risk is high, right?
You will have to kind of see the risk and the probability as well. Okay, both the impact, the probability, both the things. Okay, whether it is worth it, whether those things will happen or not. For example, uh, when you buy a particular laptop, okay, would you kind of want to go in for an insurance or an extended warranty? Yes or no? That depends. Okay, you would want to see because it will have some cost associated. Fair. So it depends upon whether you want to kind of have that particular extra cost or not. Do you want to if there will be likelihood, if there will be probability, if there will if there is a chance that that particular product will malfunction, that's when you would want to go in for an insurance or a extended warranty.
Thank you.
Welcome.
So, it's mentioned there creating a joint venture to transfer a proportion of the risk. Sorry, a portion of the risk. So in that case, then even if you sell part of your business or you divest diversify or something, does that also become transfer or will it be reducing?
Okay, so joint venture is another concept. Okay, joint venture basically means that let us say I want to build a what do you say, an airport, or possibly I want to kind of build up an entire mini city kind of a thing. If entirely I put in my capital, it's not, I might not have that risk appetite or the capital available to kind of operate such a big project. So
Yeah.
possibly what I do is I enter into a venture with another person. So for example, Reliance and Tata coming in together to form a short-term entity for a particular project, maybe for creating the airport or for making a flyover or XYZ. Because two people are there, hence the risk is getting diversified. It's getting split between both the parties. Okay. Diversification, on the other hand, you can think about from the perspective uh, when you invest money. Okay, let's say you're investing money in the stock market. If I only invest in, let us say, HDFC Bank, and for example, the share price falls, my entire portfolio is gone. Okay. Now, in order to diversify, what I can do is I can buy some shares from the banking sector, some from the commodities sector, some from the consumer sector, some from the possibly IT sector, so that even if the banking sector is not working well, the other sectors are still performing. That's diversification.
Okay. Got it. Thank you.
Most welcome. Okay. Whenever you are developing the risk strategy of a company, okay, let us say you're a part of the risk committee, or possibly, you're a part of the internal audit team, you are looking at the risk exposure of any company. What you will have to see is the appetite of the stakeholders. Okay. So let us say I am management, I am the director of a company, I'm undertaking business decisions. Now, just to earn quick money, I might be okay to invest in, let us say, cryptocurrencies. But are my stakeholders, such as my employees, my shareholders, are they okay to invest that particular money in crypto or not? Okay, so you will have to see what is the appetite. Appetite basically means bhook. Okay, how hungry you are. Okay, so you will have to see what is the appetite of my stakeholders, particularly my shareholders. Because if I take a lot of risky decisions, whose money will get lost? Mine or the shareholders?
Shareholder.
Obviously,
Shareholders.
shareholders. So, that is the job of the risk committee. Their job is only to go ahead and see how much risk exposure is there. Okay. And what is the appetite? Is it within the appetite of the stakeholders or not? Some risks might be positively correlated. So for example, one risk goes up and the other also goes up. Okay. So for example, if your environmental risk is going up, at the same time, your reputational risk will also go up, because if you do not comply with the environmental laws, you will first face adverse reputational loss. Okay, there will be negative articles against you in the media. At the same time, there can be a negative correlation as well. So if, for example, you're spending money to mitigate the environmental risk, okay, so if you're spending money to mitigate the environmental risk, what is happening? Environmental risk is going down, but your financial risk is increasing. You're not getting that return, specifically in the revenue form, from the environmental risk. Okay, so it can be a positive as well as a negative correlation. What the companies basically do is they hire a risk manager. Okay, maybe the internal audit team or the risk and compliances team come into the picture. They see what are the management policies. How do we ensure that the risk level remains alarm? Alarm basically means as low as reasonably possible. Again, you cannot mitigate the risk 100%, but you would want to keep it as low as reasonably possible. Okay, and you will essentially report it out the risk committee. How do we manage the risk? What is the process? First of all, identify what are the various risks that are there. Then assess. When I say assessment, again, check the likelihood, check the impact, categorize it into a high, medium, low. Then plan. What do you want to do against this risk? This is where the TARA framework kind of comes in. And lastly, monitor it on a daily levels, because it might, the impact, the likelihood might change from one day to the other. So that's the risk management cycle. This, guys, it's an incorrect diagram. Just ignore this one. It's not the diagram for risk management. Again, how would you want to assess the risk? Again, checking in the impact and the likelihood. Based upon the impact and likelihood, you will apply the procedures that again comes in the TARA framework.
सर ये पेस्टल एनालिसिस क्या है?
It's a part of the strategy chapter. We'll cover it at a later stage.
Okay.
Are the risks dynamic or static in nature?
Dynamic.
Obviously, no risk remains constant. The risks are always dynamic. Why? Because even if you are not doing anything, still there can be changes in the outside market, in the outside environment, which will impact your company. Okay, so possibly, the interest rates going up and down, any change in policies, procedures, political parties, political setup, etc., will have an impact. Fair. So that's the risk remains dynamic in nature. Alarm also we have discussed. Risk register is something that we will cover. Okay, let's take a quick break for 2-3 minutes, and then again we'll resume the session. Quick 2-3 minutes ka break. Okay, sharing the screen again. See, what all the companies will do is they will basically prepare a document known as the risk register. Okay, risk register will have basically all the details of risk identified till date. Okay, so it's a as on date document. Basically, it will contain all the details. I'll give out a risk ID. So let us say risk ID is A1, and then I'll give out a risk description. Give us one risk that my particular company faces is, for example, flooding. Okay, and then I state out the assessment of the risk, whether it is a high or a medium or a low. Okay, then I also highlight who is the owner. So for example, in this case, the warehouse manager will be the person handling this particular risk. He will be the risk owner. He will be the one responsible for kind of taking care of these risks. Okay, after that, I will mention what control have I implemented. Okay, or possibly after, before the control part, I would want to say date identified. So let us say we prepared this document today. So we say, okay, 22nd December 24 is when we have identified the risk. Then we kind of put up a control over here. Okay, so for example, flooding is the risk. I install heighted racks so that my inventory does not get impacted because of flooding. Okay, so when have I implemented the control? Let us say we've implemented the control today, and then we also perform a impact after implementing control. So for example, it was a high over here. Possibly after the control has been implemented, I was able to kind of reduce the impact, and then it has been identified as a medium one. Okay, so what is essentially happening is that across all regions, across all the risks, I am identifying what are the different risks applicable. Against the risk, I'm also identifying whether any controls is there or not. And after the implementation of controls, what is the level of risk that still remains? Because I cannot eliminate the risk 100%. Okay, some risk will still be left. Is it similar to RCM? Yes. So RCM or risk control matrix or risk and control matrix, whatever you call it, that is at a process level. Okay. So for example, you prepare an RCM maybe for the procurement function or for the sales function or for the credit function. RCM is a document prepared at a process level. Okay. Whereas this risk register, this is essentially prepared at an entity level. Okay, so that is the risk register. It will have the description, when was it identified, what is the likelihood, what is the impact, what is the pre-mitigation rating, that means before the implementation of control, whether it is a high, medium or low, who will be the owner, what will be the response, do we transfer it, accept it, reduce it, what is the likelihood after the mitigation. Okay, post mitigation rating, is it a high, medium, low, when this control should be implemented, when should be the response be implemented, and finally the risk owner with sign off. So that's a risk register. The ERM or the enterprise risk management, this is basically a framework provided by the COSO society. Okay, by the COSO framework has basically provided this ERM for you. What is happening is it is basically giving out the key principles and concepts with respect to, and a clear guidance with respect to how should entities manage the risk. Okay, it at the top, it looks very, what do you say, difficult, but it's fairly very easy. It is just a cube in front of you. Well, simple cube. At the top, what you have is different kinds of risk that the company faces: strategic, operational, reporting, compliance. Okay. At the right side, what you see is at what levels are the controls getting built in. So do I put in the controls at the whole entity, or just a particular division, or just a particular business unit, or just one particular subsidiary? Okay. So for example, uh, what do you say? The risk of flooding, I do not have to kind of put in at an entity level, only that particular business unit, for which area that area is prone to flooding. Okay. So at what level have you implemented the risk? That is on your right. And on your front is again nothing but your risk management framework. First of all, you will see, if you want to assess the risk, you will check the control environment or the internal environment. Control environment, internal environment basically means what is the intonation of the company? What is the tone at the top? do the companies value controls or not? Do they have controls or not? Do they have authorization procedures? Do they have segregation of duties? Do they, are there any policies in place or not? Then based upon your control environment, you will set up a objective. Okay, that what is it that we want? What kind of an organization do we want? Do we want controls within our organization or not? Then is an event identification means at what basis are you identifying the risk? Fair. So for example, a new competitor enters the market. That's an event. A new product gets launched. That's also an event. Post identifying the risk, you do what? You assess the risk, high, medium, low probability impact. You develop a response, the TARA framework. You implement controls. Once you've implemented the controls, you share information with respect to those controls across the organization. And because it is a continuous process, you manage these controls, you monitor these controls on an ongoing basis. Okay. So I'll just quickly repeat for you. At the top, nothing but the various kinds of risks that the organization faces. At the right, we have the at what level are the controls implemented, and towards the front, you have what is the internal environment, control environment of the company, what is the objective setting, what are the various events basis which we are identifying the risk, then a risk assessment, high, medium, low probability impact, then a risk response. Here you can write the TARA, then the various control activities that you guys have implemented, then information and communication across the organization, and last, on an ongoing basis, you monitor the risk. So 4 objectives of business: strategic operations, reporting, compliance; 4 organization level: subsidiary, business unit, division, entity; and 8 components that must function effectively for the risk to be managed successfully. Very quickly, any one question we can do today, remaining possibly when I am at a better health tomorrow, we will be able to kind of cover the remaining set of questions. Hiji, very quickly, giving you guys 5 minutes, read through the question in front of you. What you have to basically do is you have to identify and explain what are the different risks across the organization. You basically have to bifurcate them at a strategic, tactical, and an operational level. Screen has frozen. Reshare it. Okay, are we done?
Yes.
Chalo ji, perfect. Uh, BTS company manufactures and sells chairs, sofas for use in sitting and living rooms. The company's products are displayed on the internet site and orders are received via the site only. Order processing takes place on the company's in-house computer system along with the inventory control and payment to suppliers. The computer systems are managed in-house with no external links other than internet for selling. Any risk you could identify over here?
Yeah, this is actually a strategic risk, as per my knowledge. Um, because nowadays, if you take one particular furniture company, it is available in multiple sites. For example, take Flipkart, take Amazon, other websites also. So, just advertising in only one website will reduce their sales. So, this is a strategic risk, as per my knowledge.
Okay, fair enough. Uh,
And
strategic over
I,
dependence on IT. Absolutely, yes. There's too much reliance on this particular technology. At the same time, it's kind of an in-house system. There's no, other experts to kind of help you out. Not just, the sale part, even your inventory management, even your payment to suppliers, everything is there on this particular site. Okay. So if this IT system goes in for a toss, then you do not have any particularly other system to rely upon. So what should happen is, to eliminate this risk, you should have basically a backup maintained at some offsite location. Okay, so your server possibly will have a backup. It should have a backup being maintained at an offsite location. So for example, if something happens to your website, immediately your backup can come in and take charge.
I got it. So what about their sales? So, but since they are relying on one website only,
Yeah,
their sales
I
might
agree
also.
with your point. Agree with your point. Over dependence on only the in-house website. There's no other selling media.
Can we assume there's no physical presence as well? And will that also be a risk?
That can also be a risk. Okay. But
Like,
all of this is, yeah, kind of covered into one pointer only.
okay.
Okay. Then next is production is carried out in BTS factory. There is little automation and production is dependent upon the knowledge of Mr. Smith and Jones. Similarly, BTS, okay, till here, any risk?
Yeah, here.
Yeah, I think it's an operational risk over here.
I think it's a strategic risk.
No, I think it's operational because about the human resource is limited over here. That's why.
Yeah, if anything happens to these people, then the business itself is gone for a toss.
Production can be lost.
Yes.
Okay, absolutely.
Yeah, and if nothing happens to them, but the knowledge is limited, there's no external knowledge over here.
Yeah, it's not that Mr. Smith and Jones are kind of dying, but they might go to a competitor. So there's over dependence on two limited key personnel. How would you want to eliminate this risk is because either go in for automation or possibly, there should be a proper knowledge management in the company. That means your entire production procedure should be documented in a standard operating procedure. And, so that if by chance these two guys are not there, still the work goes on. Okay. BTS rely on Woody Company for the supply of 80% of wood used in the manufacture of BTS products. BTS supplier policy is to pay as late as possible, providing little information on future requirements. Any risk over here?
Yeah, sir, I think it's strategic risk because 80% is quite material and it challenges the going concern of the company.
Challenges the going concern. Okay, if
Yeah.
really, that is not available. But I would not want to put it into strategic. Why? Because there's no much information about if there are backup suppliers available or not. If it would have clearly called out that there's no other supplier vendor available for this particular product, then definitely yes, it was a strategic level risk. Okay, but right now it's more about a tactical or an operational level risk, or sorry, operational level risk. Why? Because there's no information given about other vendors. Okay, yes, there is too much dependence, so that is a risk. At the same time, the policy is to pay as late as possible. Okay, so that's also not the correct procedure, because if, let us say, Woody kind of stops supplying or does not want to do business with you, then you do not have any other backup. Okay, so how can you alleviate this risk is, A, go for search for other vendors that might be available to bring in that particular quality of wood, or you know make them, instead of a vendor, make them as a strategic partner. Okay, so that these guys are also heavily invested in your business. You give them information about what kind of wood and what quality, what quantity would you require, so that they are able to better cater to your requirements.
So this is a tactical risk rather than operational risk, right? More than because this 80% dependence on one particular vendor is not an operation risk. So what operation risk is that there is any failure from internally, that is operational risk, but this is not internal. This one, this is like they are over dependent on a particular vendor, so it is more of a tactical one. And as you told, instead of keeping him as an vendor, we can keep him as a partner. So it is a tactical strategy. It is a transfer of risk. What you are
Yeah,
telling.
the elevating part, the
Yeah,
second part of the
yeah,
question.
yeah.
So we can put an assumption in the answer, right? While identifying the risk.
Yeah, not the assumption, but the justification would be the correct word.
No, I don't understand. Like you said that there's no information given about that. That's the only supplier they rely on.
Yeah, so if you
They
say,
have a
so if you very clearly call out that yes, boss, assuming that there are no other suppliers available for this particular quality of wood, it can be classified as a strategic one as well. But in the current case, majority, it will be a tactical one in the current case.
oh,
Either
okay.
if the classification is correct. So both these two, over dependence on Mr. Smith and Jones, and this one as well, would both are tactical level risks.
The second part, as late as possible, would also impact the reputation.
Reputation, not as much, okay, because reputation is kind of considered in the eyes of all the stakeholders, not just one particular party.
Yeah, but like their supplier policy is that. So even if they supply 20% of the goods from other suppliers, they follow the same policy, right?
In a way, but yeah, that's a limited impact. I would not want to kind of put in a separate pointer as a reputation risk.
Okay.
Okay. Other raw material. Yeah.
Aim, as late as possible and getting more information on the future requirements. That will be more of a strategic risk, right? Because it impacts the going concern, maybe the cash flow.
Sorry, which one are you saying a strategic one?
The getting the payment as late as possible and having like little information on the future product requirements.
That's
Can
not a
you
strategic risk. Why? Because it is saying that we do not
exactly
provide the information to the vendor. It's not that we do not have that particular information. It's just that to the supplier, we are not kind of providing in them any information. Okay. So it can be either the entire thing is a strategic one or the entire thing is a tactical one, basis how you justify your answer.
you can't split it up into like two risks?
Sorry, your voice was breaking in the middle.
Can you split it up into like two risks or
See, ideally, this particular, the Woody company part, it will be one risk. Either ways, you kind of justify either a strategic or a tactical.
Okay. Fine.
Other raw materials purchased include fabrics for chair and sofas. However, minority of the sales orders, minority is a keyword over here, are lost because the correct fabric is not available for the customer. The main reason is stockouts because the procurement manager forgets to order. So what is the risk over here?
Operating risk.
Absolutely, that's an operational risk. And to kind of mitigate this risk, what we should do is we should have a automatic, ordering system in place, wherein as soon as the quantity kind of reaches a minimum threshold, an automatic order is placed with the vendor. BTS products are distributed by Fastcore, a nationwide courier firm. However, due to the size of the chairs and sofa, it is essential that the customer is available to take the delivery of goods. Fastcore offers a 2-hour window for delivery, although 55% of the deliveries are meeting these criteria, providing a poor publicity for BTS and an increasing number of customer complaints. The board do not believe a strategic review of courier services is required at the time. What is the risk over here?
The strategic risk only, because more than 55%, there is an issue. It's not a minimal, it is major, right?
No, it says 55% of deliveries are actually meeting these criteria. Like 55% is successful.
Sir, I think it is a tactical risk because it is related to delivery of the goods, right? So I think it is a lower level risk, and because of the delayed deliveries.
Okay. So this again, you can classify either strategic or tactical. My inclination is more towards strategic. Why? Because as a strategic policy, they only have one particular vendor, courier firm. Okay. What should be the case is, boss, they should have multiple courier partners, because at the same time, this particular window is providing them poor publicity. So if, example, you are an internet-based company, and your courier services are not up to the mark, the customers are not getting the orders at their preferred time, they will stop ordering from you. So that's a very high impact. And almost close to 45% of the deliveries are not successful. Okay. So what should happen is we should have what? A better or a more variety of couriers. We should kind of assess their performance, and basis that, we can assign more deliveries. Too much dependency on one particular courier partner is a strategic level risk.
Yes, sir.
So
Correct.
there could be another solution to this, that you can get a confirmation from the customer you're delivering today. Like if I'm delivering someone today, I have the goods at my warehouse as the courier company, and I can ask for the confirmation that the customer is available at what time.
Yeah, preferred time, you can consult with them. Absolutely, yes.
You could also just change the distributor, right? Or maybe just leave the furniture at the door of the customer.
And that's a debatable one. What if someone takes my chair away from outside the gate?
That'll be unlikely, but it'll be more of an operation risk center.
Depends upon the area that you live. It might become very likely as well.
Yeah, true.
But it's
I
very heavy to carry, no? You'll know if someone takes it away. You can
yeah,
catch them.
catch them. Okay. Chalo, that's a different strategy altogether. Nonetheless, guys, I'm sorry, not feeling the best today. Hence, it is a fairly very short session. Tomorrow we'll start on time. We'll have the full session in place. Meanwhile, just see if you can go through some other questions from the risk chapter as well, or if not, possibly go through the solutions, go through the text as well. Tomorrow we'll kind of pick up a more detailed section and cover more questions. TK ji, so that's it from my side.
Tomorrow what we will be covering actually?
Okay, tomorrow what do you want to cover? Tomorrow I think we can cover leadership. See, depends two things. One is that we cover leadership. Second is we cover organizational control. Organizational control and audit is somewhat related to the risk part. So I would recommend let's close this out first.
Okay.
Agents, governance, and board of directors. Yeah. Okay. So first we'll try to cover this one. Whatever time left, we might go in for another chapter.
Okay. Yeah. Thank you.
Okay, ji.
Well, let us go in a normal pace only, because if today to complete that entire study text for sculpture, it is a challenging only, because It took me more than 2 days to cover the governance part only. It took at least 1 day, not one, I mean, like 4 hours, 4 hours. So it is more, it is higher than this governance ship. So it takes some time. This
Okay.
risk.
No worries, no worries. Done, ji.
Also, I think you guys have created a WhatsApp group I saw in the recordings. I joined for the first time today, so if you guys could add me in it too.
Okay, can someone please
Yes,
share
sir,
the
me
link?
too. Please add me also.
Okay. As is, I think now there's an official group as well.
I'm
That,
not added to it.
yeah, that official group, that link is not, they have just pasted it instead of giving the link. They have just pasted the text.
1 second. Let me see.
Is there a separate group for the students?
Yeah,
Yes.
I am sharing the link. Wait.
You
Okay, so this is the link to the official group.
Sir, can you share this link in the we have another WhatsApp group, right? Students WhatsApp group. Can you share this link there?
Sure.
SBL ACCA official, that group. Can you share?
Sir, could you please share the link for the students group as well?
Yeah.
Thank you.
I am not an admin over there, so I don't think if I can.
I
You
think
can share the
someone's
link.
shared it already.
Sorry? Yeah. Chalo ji, thank you so much. I will see you guys tomorrow 9 a.m. है ना?
Yeah. Thank you. Thank you.
Thank you.
Take care,
Bye.
sir.
Thank you.
Thank you, sir.
Thank you, sir.